as that begins to recover, there's sort of a plethora of things to look at and invest in China. So I think if you're selective, there are now lots and lots of good opportunities. And as you say, with the A-share inclusion, people are beginning to take notice. And that's important because that kind of flow of money and flow of interest is what will get the stocks to sort of mean revert and rebound back to some kind of more normal valuation.
Okay, Bill, thank you for that. And later on in the programme, we'll try and get a little bit more granular with you and talk about how to express that conviction on A-shares and whether it is new economy or old economy infrastructure. Belt and Road is gathering some momentum or possibly losing some momentum, depending on your point of view. Right, Bill Maldonado there of HSBC Global Asset Management. We'll return to him later on the programme. Lots more ahead on Squawk Box, including the chairman of Emirates weighs in on the grounding of the Boeing 737 MAX 8 and how it's impacting his business. First on CNBC interview coming up a little bit later on the show. We'll be back in 2.
I'd like to donate these books.
Thank you very much.
Where do you get that book?
A man donated it.
Yes?
I'm sorry, but I need to retrieve
I don't leave you looking for this.
No. Thank you so much.
Return the book.
Explore key trends driving today's iron ore steel industry and how they shape market development. Join us and industry leaders at Asia's premier iron ore and steel event. Visit ironoreweek.sg for more information.
We rely on packaging every day, but with plastic in the spotlight, we explore the technologies aiming to keep it in our economy.
This type of process can handle virtually all plastics and is a very powerful tool for the waste industry.
And the innovations that could disrupt the packaging industry.
We're right at the cutting edge that will enable us to go entirely plastic-free.
You have a corrugated box and you have reduced the amount of plastic to 60%.
The future of packaging, only on CNBC.
I think April has been more constructive, and I'd say overall from a macro perspective, U.S. economy is doing well. I think there's no question China has responded better to stimulus. I was in China, 2 weeks ago and spent a little bit of time there. Europe, Japan lagging a little bit, but generally, from a macro perspective, the global economy is moving along pretty well.
But what do you see in terms of client activity?
Client activity has been better. So we had after the kind of the fourth quarter speed bump, and with the government shutdown, you had a very slow start to the year, but we saw a pickup particularly in March, and activity has been more constructive in April. And particularly we're seeing it in capital markets activity. You see obviously IPO activity, and that's really starting to gain some momentum. So I'd say, more constructive.
Goldman Sachs chairman and CEO David Solomon there weighing in on the state of the markets and the economy. Let's return to Bill Maldonado, of HSBC Global Asset Management. Bill, when you look at the US indices, you've got the S&P 500 knocking on the door of 3,000. It's looking pretty toppish. Is that max headroom, do you reckon, for the US markets? And do you think there's better value and better opportunity outside?
Yeah, so broadly speaking, yes, I think you're right. What's perhaps more of a concern even than that on the US market is how concentrated it's been in the last couple of years. So typically you might expect half the stocks on an index to outperform the benchmark, the index, and half to underperform. There are times when that kind of shifts around, but over the last couple of years in the US, we've seen a big concentration, so perhaps only 25% or so of stocks by market cap outperforming, and we know what those sectors have been. That concentration is probably not sustainable longer run, so that creates an interesting dynamic for investors. And I think that's where we would be focused on those names and whether they can continue to do that.
Bill, I think there's also a concern among some investors that so much of this rally has been Fed-driven. And at the moment, if you look at what Fed fund futures are telling us, nearly 70% say there could be a cut by January of 2020. Yet that's not the message we're getting from Fed policymakers. And some of the growth data, if you're willing to look past the weak inflation, is extremely strong. So are we potentially setting ourselves up for a big disappointment in the markets?
Well, I think that the recurring narrative, almost since the recovery from the global financial crisis, has been investors looking for that recession. We had a phantom recession in 2016, if you remember. Everybody was very worried about the US and China and the renminbi. That didn't happen. We went into a very strong synchronized growth period in 2017, which was very positive for asset markets. And again, we had concerns about a recession in 2018. That's very clearly not happening. And again, we're seeing a stronger period of time. So I think it's a recurring thing. Investors much more worried about the downside than about taking advantage of economic strength and how that feeds into the market. That creates opportunities for savvy investors, but also can create a lot of volatility, as we've seen.
Yeah, Bill, Nancy and I were having a very heated debate yesterday on inflation and why it hasn't reared its ugly head, given the tight labour markets and given the rise in oil, etc. Payrolls on Friday. If we do see a pickup in the wages element and wages growth, then is that going to be the feature that really scares the children in the markets?
Well, a couple of things. One, there has been a steady pickup in payrolls in the US, but in a very kind of controlled way, certainly not in a way that looks like it's going to trigger inflation. But I think the second thing to say is that whilst the market is very good at pricing in downside growth risk, i.e. it's perennially worried about the next recession, the market is not at all pricing in inflation risk. So even though we don't think that there's a big inflation pickup around the corner, if we look at one area of the market where the risks are not being priced in our view, it's on the inflation side. It's likely not something that's going to bite us anytime soon, but if you want to worry about an area of the market, that's probably the one to keep an eye on.
Bill, I think that's a fascinating point to bring up in this environment when pretty much everyone is talking about how elusive inflation is. So if you're more on the optimistic growth camp that inflation will pick up, because inflation can pick up quite quickly here, I mean, what are you looking at in the way of inflation protection? What would you be buying?
Well, I think that stocks are typically the way that people can really protect against kind of a sustained period of inflation. That kind of implies that we're going to get a prolonged cycle until the Fed decides that there's a bit too much inflation in the system. So I think stocks in general is the way to play that. But I suspect that central bank authorities are likely to let that run for a while. Inflation has undershot for a long period of time. If it runs a little bit hotter than the normal for a period of time, that's maybe no bad thing. And again, that could be relatively positive for the stock market until rates begin to rise significantly in response to that. But we don't see that. That's not on the horizon anywhere in the foreseeable future.
All right, Bill, we'll get the final word from you coming up here in just a little bit. We are off for a quick break, but we'll be back in 2 minutes. See you then.
Today's Forex Update is presented by Interactive Brokers. 120 markets, 31 countries, 23 currencies.